I want to test these ideas with two people I absolutely respect, Alex Manson and Barney Frank, and reconnect these ideas with some of the things that are happening or taking place today. So I'm going to ask Alex to give his top of mind reaction to what I've just said. And I'm holding my breath because we don't rehearse this thing. And then for Barney to give his reactions. And then I would like all of you to ask questions and take this conversation in any direction that we want.
Thank you. Top of mind reaction, as I was reflecting on travel, clearing immigration. You know, when they give you a landing card in a plane, you have to, a lot of countries aren't digitized yet, and so you actually have to write down your name, one letter per space, and at some point they ask you for your occupation. And the question is, what do you write? And I never thought of it. And certainly pre-08 banking crisis, banker, no problem at some point. So the point is, what do I write today? And the answer is banker still, which is an interesting fact, right? So we're talking about identity and taking the question, why? What does it mean? And I go back to an intimate conviction, which is that banking and financial services is actually useful. It's actually useful. It serves a purpose in the world and society specifically. The question is how relevant. How good a job are you doing in the first place, but also how relevant, and importantly, how do you make this relevant for generations to come? The immediate top of mind reaction is that we're having a conversation about the future of banking, we're having a conversation about technology. And so the questions are, what does that mean in the context of banking and financial services? What does it mean in the context of identity? You and I are having this debate about whether controls identity, controls finance. They're all about transacting, but really going to the root of the societal questions that are being asked now, and what does it mean for us to fulfill society's expectations of financial services?
In order to put it in context, is you make decisions on investing in disruptive technologies. What guides you?
It's less about investing in technology than it is about investing in a new form of DNA, which is how you do business, how you serve customers, how you do things that are wrong. So predominantly, I think we're looking for problems worth solving. We're looking for use cases. We're looking for the way customers want and in fact need to be served. So what we're building, when we're investing in technologies, we're also building businesses, and those businesses, which we build as operators of businesses, are different business models, meaning for different ways of serving customers and at large addressing society.
In your position as chief executive of SG Ventures, do you find yourself intellectually honest enough to invest in technologies that can disrupt the very institution that you are working for?
The premise is we need to evolve, we need to change, but this is not going to happen unless we are willing to capitalize, unless we're willing to compete against ourselves, unless we're willing to do things fundamentally differently, which is potentially detrimental to the existing business. And so destroying the organization for the sake of building a better one is just not an option. Hence the conviction required that we're going to change from within. We're going to digitize the bank. We're going to improve it, but we're also going to build things that are fundamentally different and could, over time, replace the existing bank or complement it or form adjacencies that we can't even think of. And so the honesty comes from that willingness to overlap, at times compete a little bit, do things differently, do some of the same things very differently, completely different things, and build financial services the way we're envisioning them in the future, driven by customer needs and what society is expecting, but separate and distinct from the existing organization.
That is the introduction so that we can, there's lots to discuss.
So I think what the job is, first of all, to accommodate the new technologies to give people and let people take advantage of that, to let people who have the ability and interest in taking on more of their own activity, get the savings from that, the efficiency, but understand that large numbers of people are always going to want institutional intermediation. And not only that, if we did not have that, it would go bad. Side point on that about inclusivity. I agree with you. There's two kinds of inclusivity. What we have talked about at the federal level, by the way, is not increasing the poor's ability to borrow. We are increasing their ability to get money without paying enormous fees. I want to abolish check cashing, which costs them a lot of money. We want to abolish the extreme fees on currency sent back home. What we're talking about is giving them free checking accounts so they can get a paycheck and when they get their money. That's what we mean by inclusivity. I agree with you. Once you go beyond that, we're not trying to monetize them. We're trying to allow them to monetize what they're already earning. And I'm glad you said that, because I think I will be more clear in the future to say we are talking about giving them access to that money for free. Next point, if we get the banks out of their current business, who is going to do the lending that I assume will be society needs? Who helps people buy the houses? I mean, somebody's got to have that lending function. And if deposits are not the basis for the money that's lent, what will be? Next point is that when you say the banks will compete with each other with their stable coins, how do they compete? Well, how do you make money? I issue a stable coin at the bank. How do I make money off that?
The comments that my two distinguished panelists are throwing in are very important to bring the 30,000 pips, ideas to what's achievable today.
Right, great. I'm a banker. Can I help?
Yeah.
What is missing in the context of digital assets? I've mentioned the word today, robust, safe, compliant infrastructure. If you trust me with your money, because I'm a bank and you just put it in vault and now it's a digital vault, perhaps you might trust me with information and records, financial record, how about health records, how about any sort of data, how about identity management, which is ultimately what you won't be in physical or virtual reality. It's a number of things. So I started with infrastructure and trust around infrastructure.
All comments valid, okay? Just for clarification on the stable coin, the value of stable coins is the utility. In other words, you add functions to it, and banks compete on that. And even now, the beauty of stable coins and of crypto is not the value. It's not crypto being $30,000 today. It's the fact that there are easily 300,000 programmers working on applications on, Uniswap, for example, right? Or any one of these crypto. So it just attracts anybody out there.
You have to make it more attractive to the
whatever the utility of it, right? And people will continue being farmers and carpenters and whatever they want to do. But when the time comes for them to transact value, they will be scrambling for how can I create a token that can be bought or sold. So valid comment, because Adam Smith said that it's a small business that's the most efficient form of organization. But what happened from the 300 years since Adam Smith was that it was large businesses that dominated. The reason big businesses eventually took over was because there was a dissymmetry of information between big business and the individual. The individual had no idea what the cost of labor should be or how competitive his cost of production was. It was the big business that could consolidate his costs and be more efficient. Today, you see greater symmetry of information. In other words, the end user has the same information as the producer. And so the dynamics are changing.
So here's the problem with that. The information can be available, but accessing it can be difficult.
Yeah.
So if I am a Fortune 500 corporation and I got to figure out what bank it's safe to put my money in, although increasingly they may not do that, but I can have a whole department of bank analysts who can decide and look at the bank. But if I'm a guy running a small manufacturing business, I don't care if that information is available. I haven't got the time or the expertise to learn it.
But now with so much information available, people can put up the entire balance sheet of the bank and show there's a $60 billion hole in there. Okay, one more question to Barney before we open this up. How has your mind evolved since Signature?
And I agree with both of these guys that it's the information technology. We had a financial crisis 15 years ago, in part because information technology enabled institutions to get into what we would technically call financial razzle-dazzle, and it got away from us. That's now migrated. That information technology has now empowered the individual depositor. So if you want to get your money out of the bank, a bank run was called a bank run because it was a physical journey to get your money. With moving your deposits from a bank now consists of, and it's moved, 2 buttons. And so we have back in the 3 times in American recent history, the federal regulators have expanded the deposit insurance guarantee amount to deal with the crisis. 2008, the pandemic, and now. I tend to think if you have had to do something 3 times to deal with the effects of a crisis, maybe it's time to think about doing it before the crisis. 2 weeks before we were closed by the New York state regulator, no federal regulator was involved, except the FDIC had the duty to carry it out, mandated to them by the New York state regulator. We were not a federally chartered bank. We were state chartered and subject to the state regulator. And 2 weeks before, we met with them and the federal regulators at a regular meeting, all the board was there. They reaffirmed our number 2 camel rating. They made no alarms about things. On the Friday before we were closed on Sunday, $12 billion in deposits migrated out of our bank in 2 hours on Friday afternoon. And I believe it was because we were known as one of the most heavily crypto involved, as Emmanuel pointed out. We were not at risk if crypto lost in value. We were a payment platform, other people were, but that scared people. And we were trying then to reestablish ourselves, and but the New York regulators shut us down. Had they not shut us down on Sunday, and we opened on Monday with the new liquidity facility that the Fed had opened and the guarantee of above 250 deposits, we would have been fine. But so in our case, Silicon Valley had some problems. In our case, it was simply, I think, a crypto hysteria generated, technologically turbocharged deposit run.
Was that regulatory overreach?
I think what happened was this. I think the regulator was worried about crypto and decided to send a message that they want to discourage the banks that were under their jurisdiction to get too involved in crypto.
So this reminds me of the sort of thick skin that it takes to be a crypto fan in the context of the story you just told. All we're saying is back to far you cannot uninvent digital assets are here to stay. So we've got to deal with it. We're going to deal with it from framework perspective, from infrastructure perspective, from regulatory and policy making perspective.
Thank you very much. Very, very interesting insights from all 3. And then what Mr. Barney Frank is saying is ordinary people, they're always going to want institutional intermediation for financial services because they do other things and that's good. And then you need government regulation. Some people are ideologically opposed to, but you need it. But I think the great insight of your book is that, given these other comments, that for the first time in our lifetimes, technology, data, all these new platforms and so on, are going to transform the way that banking works. And I mean, I started banking in 1987 in Hong Kong doing trade finance. It would have been recognized by somebody who walked in from 100 years before. It was basically the same thing.
Well,
Yeah. But today, for the first time, I feel, Emmanuel, you set it up perfectly in this book, The Great Transition. Everything is going to change. We just don't know how.
It's difficult today because it's new. I don't, it may well be that the trends that you described, which I agree are happening, 30 years from now, that may be easier to do. There were things that people would have been terrified of having to do 30 years ago that they now can do more easily. So that may come.
The other transition is so if we're evolving from markets to connected world, the markets to be individuals in a sovereign capacity rather than nation states going to develop, but individuals deciding what is useful and how will they decide about it, with what sort of information and what are the consequences of the decisions are used, which is, you're right, for the rest of we don't know how, but this is what we're envisioning in the book and in this conversation.
Yes, question. So, go on, Shankar.
Thanks, thank you. I just wanted to make sure I didn't miss the opportunity to talk to Mr. Frank about the 848 pages that you wrote for the Dodd-Frank agreement. I'm not sure I understood all of it, but I did have a chance to read that many years ago. In the current environment, do you see more regulations? Do you see less regulation?
I do not think you're going to see much, you're not going to see any legislative change in the basic bill. I think you will see under the Biden administration a tightening up of their administration of the current procedures. In 2018, we talked about there were amendments adopted in 2018 to the bill. They did not remove any of the prohibitions on improved lending. They didn't deregulate derivative trading or allow mortgages to be granted they should be. What they did do was exempt some banks from being under the mandatory requirements of tests, but the regulators retained every power they had to do that. But I think there is a chance of regulation of crypto. One thing, the Democratic and Republican leaders of the committee that I used to chair, Financial Services, are very friendly. I think it is possible that going forward there will be some effort to increase the confidence in crypto, which is what we needed. Go back to have competition in the crypto issuance by the banks. The key is, among other things, that you will have confidence, that people will have confidence in your form.
There are plenty of questions coming from the audience who are watching this live. But let's do the questions here first. Yeah, please.
Yeah, so thanks. This is a very insightful discussion, very interesting. I just want to put another additional lens, is that there are 88 central banks across the world who are building their own central bank digital currency. And I sit on the advisory board of Visa, and Visa works with all of them. It was shocking to understand that none of them are talking to each other. There is China, there is India, there is LATAM, there is Africa. Each have a very different use case. And there is no interoperability. So China is making the digital yuan and India is making something. They're all trying to solve different use cases. So what I wonder is that how does that really shape up in the future? And does it create even more chaos?
I'll take a shot at that. I think there has been more coordination among central banks in terms of basic financial, macro-prudential regulation since 2008. I mean, the crash required them to get together. And what I would predict, say, with regard to the crypto and others, I think they're going to be, there's no mechanism for making it happen. I think the turmoil that's now being generated in that area is going to have some influence on getting them to talk to each other. I mean, there's no way to compel it.
They might talk to each other about how they regulate things, interesting, how they might do it technologically speaking, mildly interesting, I'd say. But the bigger question is actually why?
Yeah.
What is the use case? And it's very different around the world.
I want my panelists to be, highly vocal because we're learning a lot from them. But in writing this book, I travel and visit central bank governors around the world. And I'll say this with my own personal authority on this topic. that CBDCs are designed to fail. Why? Because I sit down with central bank governors who've already implemented CBDCs, and the governor telling me that the take-up is almost non-existent. Why? And there's a huge list of reasons. The first being the banks push back on any innovation in payments. The banking industry's original position on payments is make it as inefficient as possible so that we make money on the flow, right? And second, in fact, I didn't have the slide on my presentation just now. The whole idea of crypto wallets is that it reduces the number of intermediaries so much that it makes the wallet players incredibly profitable. Today, in Africa, payment companies are generating real profit just by transacting money in a way that wasn't possible before, just because they don't have to pay Visa and MasterCard and a half a dozen banks and exchange rate as well. What is payments? At the end of the day, payments is information. And if you and I can send WhatsApp information for free, there's absolutely no reason why you can't do payments for free. But in Bahamas, for example, the entire economy is based on Americans swiping their credit cards. So when they introduced CBDCs, there is absolutely no take-up because the entire system is credit card driven. And the banks are profitable, the merchants can get paid by American visitors. So the whole CBDC platform is ancillary to the real platform, which is traditional payment systems. In China, where I spent a lot of time, all the CBDC projects are pilots, and they need to be incentivized for people to even want to use them. There is only one country where CBDC is taken some life, and that's Nigeria. And that's because the central bank is purposely not printing enough cash to pay pensions. And so there's no alternative in that way. There are a number of reasons that CBDCs are designed to fail. Firstly, the banks just would not support. The banking industry in every country, including the UK and Singapore, try to delay even simple things like instant payment as long as they can. Singapore, the delay was 2 years. People forget that. The banks didn't want faster pay to take off in Singapore. Same thing in the UK. It was only when the regulator pushes the agenda and forces the banks to provide this as an infrastructure. And if they push back on instant pay, imagine the pushback on CBDC. There was
one very important question I've asked you. You would go to the government banks. In your future, who does the lending? If I want to buy a house, who do I go to? And if I have a business and I need to borrow money to expand the factory, who do I go to borrow the money?
Funny, even today.
No, tell me.
No, even today, banks are not the largest lenders. They're not the largest mortgage holders anymore. There are commercial companies and private lenders who are not as large, if not larger, than banks in many countries.
For residential mortgages, but what about the businesses, the small business? Who's going to be, and where do they get the money to lend? If it's not deposits, where do they get the money to lend?
That's the question that the new technology players need to answer, because the ones that haven't.
I'm talking to the new technology, I'm talking to you.
Yeah. So it's a very important question, and it is being answered right now. Some of them are getting money from their venture funds, which is not valid, because that's borrowed money. It's going to run out, and that's not a way in which to run a business. Some of them are getting money expensively by providing higher interest rate than the next guy, which is also not sustainable. Okay, so that whole dimension of where you get your money cheaply in order to be able to build a lending business, that's work in progress.
No, I think I can't let you off the hook on that. You're the one who wants to abolish the existing framework, and I think you have.
The point is that there are many players today who are working at it. So the whole idea of a pay-to-pay infrastructure is that the pay-to-play players don't even get the loan onto their books. All they do is match individual lenders with individual borrowers. And the pay-to-play industry evolved for a while, and then it started to stutter because the pay-to-play players in many of the developed countries, they were always acquiring subprime borrowers to the bank, to the existing banking system. So they're chipping away at the existing infrastructure. The alternative models already exist. You're right, you need to match the borrower with the lender.
Once again, you're asking too much of too many people. Yes, some people will be able to do P2P, but to get enough people, for a lot of people, they don't want to have to, they want to lend their money, but they don't want to be the one who wants to bet the individual borrower. They need to have an institution into which they can put that money.
Yeah,
Which will then lend it in turn, which sounds like a bank to me.
yes. And so the P2P players have to build infrastructure for validating the borrowers and lenders, for creating the credit profile of
They
the.
have to reinvent the bank.
So guess what's happened? The major P2P players prosper and are becoming banks. Okay, so that's what I said in my speech.
Let me
Shirish.
ask. Firstly, I think what your book's really going to do is start this kind of dialogue we're having right here. Now, I know your book starts off by looking at the history of ICE, but finance was personalized many years ago in the form of barter trading. When we all that was what it was. You needed to get something else, and you had whatever you had. You would trade that, and that eventually became, as you know, gold became the value of transfer, which went into banks in the United States, and they issued notes against it, which eventually became fiat currency as we know it today. And then you had the Federal Reserve, and then you had central banks, which evolved because money and value of money is a fundamental issue. There is trust. Okay, I trust a dollar, or a Singapore dollar, or a US dollar, or an Indian rupee because I know it's backed by something. So let's talk about financial intermediaries. Because I think the point that Congressman Frank is making on, if I want to borrow, whom do I go to? I think that's a very fundamental and a very important question, and takes you away from this whole concept of personalization of finance, because it has been tried in different places, and we eventually come back to exactly the same point, which is who is the financial intermediary? Whether it's a bank, or you don't call it a bank, you call it whatever you want. So the issue of
what I've dealt with in the book, when you take, I'm a big critique of buy now, pay later, because despite all the technology that's being applied to it, the payment itself is no different than what credit cards were already doing, which is basically giving you the opportunity to make your payments installment over time. And the critical success factor in buy now, pay later is not the technology, it's the balance sheet. Firstly, do you have a cheap source of funding in the first place? Secondly, who are your customers? If they're high risk, you have to have enough funding in order to be able to fund the business. And then, are you a subprime player in your marketplace? Because if all the best credit customers in your marketplace are taken by your traditional banks, you're left with nothing but the brunt of the customer base. Which is what happened
buy now, pay later only works when you have a zero interest rate environment.
Absolutely.
The moment you have positive interest rates,
so
it doesn't work.
Correct. So I've taken into account everything you're saying, okay, which is firstly, it's a balance sheet business, funding cost is important, credit profiling is important. All of these elements need to exist in order for it to come about. Now, each of these elements are being developed separately, one from the other. And that's why I have the center part of my book, which is to go back into banking, traditional banking, and trying to understand the essence of what creates a credit profile, for example, right? Now, the question is whether with technology, they can build it more efficiently, with identity, that individual belongs to a close community, that you can create a profile. So that's where the technology comes in. So these are sensitivities. These are nuances that need to exist that we can actually dig from traditional banking and then apply it into whatever's being built today into the future. Ladies and gentlemen, I am so tempted to continue this conversation, but let's have a continuation as we go along. In writing this book, I did not write it to provide answers. I wrote it to provide a sense of direction from which to validate a lot of what's happening in the industry today. I started this presentation by sharing with you that it's not so much all the noise that we are faced with today that we need to focus on, but to have a sense of direction so that we know how to identify developments that are substantive, long-term. We need to put our fingers on it, and we know that in 10 years, our own lives will be transformed. And then cut out all the little developments that may be just a distraction for what we need to deal with today. And my ideas can go in any direction, and the applications of them, when we drill down to any of the decisions that you need to make, there are profound applications to be thought through. And we could have had a conversation on any one of these topics, on deposits, on crypto, on lending, on platforms, and so on. So I hope that you would have enjoyed, you will enjoy the book. And as I indicated also, that my friendship with both Barney and Alex is precisely because of the incredible and intense intellectual debates that we have and the intellectual rigor that they provide to my thinking. So I'd like to thank the both of them.